Hello everyone, Monty here, market analyst at IG, and today we're going to look at all you need to know to trade IG sentiment. But to do that, of course, well, it's not just about knowing what we're going to find on the platform, it's also about taking a look at the underlying movement. And that means we got to take a look at the psychology of human beings in general and how it's going to pertain to traders. We're also going to have to take a look at sentiment shifts by asset class. It's not always the same between, say, FX, the majors versus the minors, commodities, so on and so forth. There is a difference in terms of how traders approach it and how they have a tendency to, for example, hold heavier or for a longer period of time majority buy bias in, say, gold. And then afterwards, we're going to take a look at strategic consideration in the sense that how do we approach a level and how traders are approaching it in general. That way we can turn around and see how we can trade sentiment as a result. So with that in mind, let's go ahead and get things started. When it comes to client sentiment, you can actually find it either on IG's website. You can go search, for example, Euro USD, and it'll pull up the client sentiment for there. And what it really represents is the percentage of IG clients with positions in this market that are currently long or short. Now, it's going to come with this image here where it's going to show a circle, and you've got it cut up where, in this case, 71% are short, and that means that 71% of IG client accounts with open positions in this market expect the price to fall. 29%, a minority, are holding a long position at 29%. And remember, these are client accounts, so we're not looking at net positions. And for example, you could have one client with a huge position, a huge buy position, for example. That's not going to skew the results. That just counts as one client. That's majority buy. So while you might see some sentiment sometime come out as net long in terms of positions, here we're looking at it when it comes to accounts. And there's also additional where you can look at trading activity. For example, in the last hour, you've seen for 58% sells today, this week, and this month. And that's quite important because that's going to help us understand how we got to these levels. Are they holding these sell levels, from previous lower, for example, price levels? Is that why we're seeing these sentiment levels at a heavy sell, 71%, so on and so forth? But another place where you could find it is on the platform. Very convenient. It's there right there. When you pull up the product, in this case, US 500, S&P 500, you'll see client sentiment, and then you can go ahead and click on it, and it'll go ahead and give you the percentage short and the percentage long amongst IG client accounts. For this next bit, it's time for us to actually dig a little deeper, take a look at how exactly is it that some of the sentiment shifts. It's very important for us to start from this approach. And the reason why is because this will help you ahead of time predict where sentiment might shift accordingly. So if sentiment is on the verge of turning into heavy sell or extreme sell, and we're going to go through what those are, but when it's on the verge of going into heavy or extreme sell, further price gains might help tilt it to those levels, which means you can then, if you're looking to trade on those levels, you're then actually ready to trade. But let's go ahead and start with psychology. You'll get what I'm talking about once we get there. Our human nature when it comes to both winning as well as loss avoidance. Let's go ahead and start with winning. You got two choices in this case. One, a guaranteed income, $4,000 per month. Two, a business with a 50% chance of getting $10,000 a month. Now, think about that for a second. A lot of times, although choice B offers more, we have a tendency to take on choice A. So most of us want that consistent gain of $4,000 a month, even if on average the business is offering more. And why is that? We want to avoid risk when seeking profit. So if we have a position in the market and things go in our favor, the moment the market gets even a little bit wobbly, we see our profit, our unrealized profit start to drop. We feel that need to really close the position because we don't want to take on any risk when we're in profit. And that usually results in us taking on less profit or less profit than we'd ideally like. But when it comes to losses, this is where it can be extremely important when it comes to our positioning. Once again, I'm going to go with two choices: guaranteed $4,000 loss a month, or a business where there's a 50% chance they could lose $10,000 a month. You could lose, nothing, but 50% chance that you lose $10,000 a month. Now, most of us don't want to consistently lose. Heck, we don't want to lose even once, let alone every single day. So we'll take a chance of losing more, $5,000, average $5,000 a month, if we can avoid that guaranteed loss of $4,000 a month. In other words, we actively seek risk when trying to avoid a loss. So when the market goes against our positions, what do? Instead of us getting agitated and wanting to close our position with that small loss, we go, no way, I don't want to lose. I want to win, or at the very least, I want to avoid a loss. So what we do is we're willing to take on more risk. And what that means is when the market continues to move against us, what do? We continue to hold or even add to our positions. Very, very dangerous. Now, this is our human nature. I'm not saying this is what we should do when it comes to the markets. And this video is not about how we can train ourselves to do the exact opposite or to at the very least contain those losses. What this is about today is about trading sentiment. And the reason why I'm bringing this up is just as a prerequisite to understanding those shifts. So I'm going to go ahead and take that psychology and map it on a price chart to give us ourselves a better idea of how this works. Let's go ahead and start with gold prices back when they're a bit lower, or I should say much lower than they are right now, at least as of creating this video, and 1470. And we've done our analysis as a trader, and we're thinking to ourselves, okay, you know what? I'm going to go ahead and buy. I'm going to go in one lot, and I'm going to buy at $1,470. So the anticipating that things are going to move higher. What does market do? As it usually does, right? Goes slightly above at least slightly against our position initially, and we're thinking to ourselves, oh goodness, but what do? Our psychology is saying, hold on a second. We actively seek risk when we're going into loss, so I'm not going to close out. I'm going to try and hold on because I want to avoid a loss. Once it goes in our favor, maybe then I'll consider closing it out. Prices do move in our favor in this example. So it goes higher, and we're feeling good about ourselves. We're like, yeah, that's what I'm talking about. That's what I'd like to see. But here's the thing: when it's going in favor, how do we feel when we're in profit? We avoid risk. So the moment we see markets start to retreat, what do? We try and close out. And in this example, we close out around, say, 1,470. But let's say we weren't that quick to close out and we sort of held on to it for a little bit longer. And in this case, it jumps higher. We're feeling good about ourselves. This is great. But now we're seeing it get very wobbly and we're thinking to ourselves, I don't think it's going to go up to 88, 1489. We see it come back down and now we're getting really afraid. So we go, you know what? I've had enough. There's only so much I can handle psychologically. This is going, our psychology is saying close it. And professional traders, by the way, they have to try and contain that inner voice and say, okay, you know what, I'm going to go ahead and keep it open. But what we do by default, and this is why I'm saying that this is what we do from a psychological standpoint, we have a tendency to close it out, and we close it, let's say, just as an example, at 1479. By the way, we've all been here. So if you're thinking to yourself, oh, I've made this mistake before, or don't worry, we've all been through this. And the thing is that there are times when the market does retrace. But in this example, and I'm taking this from an actual snapshot from gold, you might have many days of oscillatory movement, but I've taken this example of what happens when it trends, not to say that you should have kept on holding on. I've really done it because I want to show what happens when it's not in our favor and the difference between how much we're making in both of them. So in this example, things got a little bit volatile, popped up above 1500. Usually when you pass those psychological barriers, things get very active. But let's say that in this case, you're thinking to yourself, okay, it's a number of hours of work, but in this case, best case scenario, I've made $900 plus, worst case, about $200. All in all, we're going, this is a good day. But that's when it's in our favor. What happens when it goes against? And again, I got to say, we have all been here in this matter. So don't feel bad if you think, this is what happened to me. It's human nature. I've even seen it sometimes with professionals and fund managers. So just because they're, in the moment, you sometimes forget your training and you sort of revert back to your inner psychology going, okay, I'm going to go ahead and I'm going to take on risk to avoid a loss. But let's go ahead and say you've done your analysis and for whatever reason, you've come to the conclusion that gold prices are going to go down. You initiate a short at 1470. Prices do go down a little bit, but before you even have a chance to consider getting out, they go back and now all of a sudden your sell position is in loss. What does our nature say? Well, hold on to it because we're going to actively seek risk to avoid a loss. I don't want to lose in life. I don't want to take that on, even though we're losing more than the worst case scenario in the previous slide. And in this case, the losses are now exacerbating. You're feeling bad, but then prices start to come back down. And usually psychologically, we're like, oh, you know what? I don't care where I thought gold prices were going to go. Say 1460 was my target. I just want to see it get back out of negative territory to zero, or maybe even slight positive, and I just want to close it out because I don't want to take on a loss, right? That this is our psychology speaking. But the thing is that in this example, prices continue to move higher. And if we're being honest with ourselves, what do we do when it reaches a key resistance point, another key resistance point, or if you're buying another key support point, we go ahead and we average in. We initiate a second sell. This is not something I'm recommending you do. I'm just saying this is our psychology. Why am I bringing it up again? Because this is what we're going to need to understand how sentiment shifts, which in turn is going to help us understand how to trade sentiment. We need to understand our psychology. I'm talking human psychology in general, because this is the trap that we're all going to fall into initially. So prices shoot higher, and now all of a sudden we're feeling bad. We're losing on both positions. We're going to try. There are going to be attempts, of course, in trying to average our way back out. You see prices retreat. That helps you feel good because you're seeing less loss. But overall, you're in the moment. You're thinking about things emotionally. You're sort of forgetting even what your initial target was, and you start, of course, trying to trade those ranges, which can yield. And if prices do come back down, by the way, you would have managed to come out at least avoiding a loss, which was kind of the goal from a psychological standpoint. Though from a trading standpoint, you're taking on significantly more risk. And if things do move higher, because some of you are thinking, oh, well, on average, if markets come back or markets at least move in a range-bound manner, even if they are trending higher, yeah, but there are going to be those times where they don't. You do get volatility, you do get an eventual move or trend to a new zone, and that just means that what ends up happening is that if in this example we're buying them back, say at $1,500, we're taking on losses on each and every one of those lots, and best case scenario, if you only had one lot open, 3,000. Worst case, we're losing 6,500. And I want to add, just in case someone started trading, they go, oh, does that mean I should never go short? No, the lesson here is that it could happen in reverse as well, because the market is dropping and you average into the buy side, that could happen. So the lesson is you obviously don't want to fall into this trap of averaging in and supporting your side unconditionally with everything, going in with this all-in mentality, which is derived from our psychology saying we want to take on, we're going to do whatever it takes and risk everything just to avoid a loss. So default human psychology, when trading, we have a tendency to take profits quickly since we avoid risk and profit. We run large losses since we're actively seeking risk and avoiding a loss. And given markets on average are range bound. Now, I want to clarify this, that I'm not saying markets are always going to come back. They could jump to a new zone, but on average, you're seeing oscillatory movement. So psychologically, we're thinking to ourselves, oh, markets on average are range bound. And because we remember those times when markets did come back after we got stopped out, if you did close out, then what we have a tendency towards, and this is not right, but what we have a tendency toward is going against the trend. So we look for ranges to go opposite instead of looking for potential breakouts. And when markets are in oscillation for a long time, I'm not saying it does happen, and it has been very beneficial for IG clients. So I'm not saying that markets are always in a trend move. No, not necessarily. But I'm saying by default, this is how sentiment's going to work, because the goal here is really to understand all we need to know about sentiment, the underlying moves. This is what we're trying to get a full understanding of this before we go ahead and try to trade that sentiment, or trade at least based on sentiment, at least a bit as one factor. It doesn't have to be the factor. We'll get to that towards the end. So in the end, so before opening a position, it's where is the market going to go? That's our question. Versus when is the market going to come back so I don't have to lose anymore after initiating, and when the market goes against. But the thing I want to point out is that the psychology can differ depending on the asset class. The reason why I want to bring this up is because sometimes by default, we have a tendency to think, okay, you know what my methodology is, no matter what traders are doing, I'm just going to go opposite. Well, there may not be a trade on some asset classes if traders there are usually stuck in extreme buy territory just by default. So let me go ahead and break it down by asset class so we can go ahead and get an idea that if you were to trade sentiment based on these asset classes, you're going to have a better idea of what to expect. Let's go ahead and start with IG client sentiment in FX. Generally, we're talking about, usually it's about attempting range trading in FX. Let's face it, you got central banks on both sides that are usually looking for controlled moves. I'm not saying you won't see a volatile trend move. You can, but a lot of times when it comes to the FX majors, not emerging markets, when it comes to the FX majors, a lot of times if there is going to be a move, it's usually in a controlled attempt, or it's at least day to day. We're talking intraday moves here and there. It's going to be usually in a more controlled attempt unless you have some big fundamental news. So a lot of times the attempt from traders is, let me go ahead and try to range trade these moves. I pulled up here Euro USD. This is a daily chart, so every candle represents a day's movement, and that thick red line in the middle, that right there is the 50% line for client sentiment, because the left side of the y-axis, you're seeing percentages there, 23%, 33, 43, 53%. That's the percentage that's retail IG client sentiment percent long, the blue dotted line. So if the blue dotted line reaches 63%, as it did in mid-March, that means that they are majority buy. When it drops below afterwards, you're seeing towards the end of March that it's around 33%. That means they're minority buy 33%, and that means they're majority sell about 67%. So they're actually heavy sell at that price when Euro USD was making highs. If you look at the right panel, you're going to see that when it was making highs above 110, you can see that the IG client sell bias was reaching heavy sell territory. But in general, we've been getting relatively range-bound moves. Even when it moved from around 108 to 110, it's relatively range-bound. And what they were doing is sort of averaging their way out, first of all. And second of all, trying to trade those levels. And you can see the blue dotted line going up and down from April onwards. And that's because you had them, trading those ranges. But how they got there was they were, of course, majority. Prior to that, they were holding majority buy, and then when it moved up, they went to majority sell, and it took a while before we finally got this move in around mid-May, where prices start to come down. And what happens is that you've got the range traders going, okay, those that were holding longs, they're going to hold on, You got fresh longs being initiated because they were looking at key support levels, and then you got those that were holding sell positions getting out and closing profit because they probably were anticipating a pullback of this amount, or psychologically they were just looking to finally close out in profit or at break even, and therefore they got out a little bit too soon. But this is essentially what it's mapping out. That is what I'm trying to get at here, is that a lot of times you're getting this range bound movement. Let's go ahead and put up the Australian dollar in this case. We got actually a big shift just from one day. It went from majority sell 54% to majority or heavy buy 66%. And what you see a lot of times is with the client sentiment shifting back and forth, you can see the red line there in the middle, and that's because the Australian dollar for much of the past 2 months has been range bound in the sense that it's been coming back towards an average. So a lot of traders have been getting, in the beginning, they weren't trying to range trade as much. They're a bit more cautious, but because it kept coming back, they started to range trade a bit more heavily and aggressively. So you see these big moves towards to heavy to extreme buy and then back briefly into sell territory. And if prices do go up, by the way, you can anticipate a lot of those fresh longs are going to get out because they're looking to trade back towards an average. So this is, in general, bottom line when it comes to the FX majors, when you in this situation, it's attempts at trying to range trade, regardless of whether markets are averaging back or if they trend and then sort of average back afterwards. It's that attempt towards range trading. What about when it comes to commodities? Here we kind of need to break it up into two parts. Let's put oil and energy on one hand, and let's put gold and precious metals on the other. I know they're priced in dollars. I know they're both commodities, but the fact is they're very, very different in terms of the moves that they experience, as well as how traders in general and investors have a tendency to hold on to them. So when it comes to oil, they've been a lot more cautious on range trading it. It's not that they aren't, they still are, but they're much more cautious because instead of oil ranging between say $80 to $100, they're now, over the past 2 years, we saw moves from single digits. If you're looking at IG's trading platform, if you're looking at some of the other pricing out there, it went negative, right? Went negative to over 120. But in this case, that within just a couple years, you had these big moves as opposed to relatively more controlled moves in FX. So if anyone's looking to range trade it, you've seen it. Even though it's been a bit more controlled as of late, you still are. A lot of these traders are still looking to be a little bit more cautious. They're not going to just be more aggressive on shifting sentiment unless there's been significant consolidatory movement prior. Now, in general, when you look at products, oil included, other products, whenever you buy, you look for a place to go short, or you look for a place to close out and then turn around and go short. But when it comes to precious metals, gold in particular, you buy high, sell higher, but if it moves even higher, buy at an even higher price again and look to sell. They're generally not looking to initiate sell positions. That has been the general rule. We have been starting to see exceptions because we're reaching record highs or we're getting towards the highs. So in general, we're looking at heavy to extreme buys in precious metals by default. Palladium's not on here, but it's also above 80% last I checked. So a heavy to extreme buy when it comes to silver, platinum, palladium. Gold was extreme buy, and I'm going to pull that up. Let's take a look first off at the daily chart. This is actually a bit of an exceptional period for gold because it has been relatively controlled, even though we're at or near record highs when it comes to gold prices. And you can see that the blue dotted line, once again, pretty much above the thick red line, which means that they've been majority buy throughout this brief period where they went majority sell. That's like the first time in years. Very rare to see that happen when it comes to gold prices. And again, that's because of where gold prices are, how they got there, and what they've been doing at these levels. But let's go ahead and pull up the weekly chart, and this will give you a better idea. Now we're zooming out to the weekly time frame. Each of these candles represents a week, and you can look back towards July at the beginning of the chart. You can see extreme buy. They were 85 reaching 80. This is an average, by the way, for the week. So they would reach 90%, but as an average, it might be around 87, 88%. And you can see that they were holding extreme buy territory, heavy to extreme buy this entire time, all the way up until you get to the start of the year where we had that spike higher. You saw the buys go down and right away go back up again towards heavy buy at around 75%. And then when we saw this big move higher, finally we saw the long starting to get out and sell buys picking up a little bit. And the reason why it doesn't dip into sell territory like it did on the daily chart is because this is an average. It's a weekly average. But this gives you an idea. The reason why I'm bringing this up is because this is going to matter when you want to go ahead and base a methodology on trading sentiment in gold in particular. That's going to matter, and it's going to give you a much better idea in terms of whether or not it's going to even trigger a signal or not. But let's continue with this section and this segment and look at client sentiment and indices and single stocks. Quite different between the two. When it comes to indices, it's really about range trading. So a lot of times when you see any bull trend rallies or even bull average, if you will, prices averaging higher, you're going to see that they're majority sell. If it's a strong trend, they're going to reach heavy to extreme sell. If it's averaging higher little by little, creeping higher, you'll probably see them in more moderate sell territory. Keep in mind there are a portion who are hedging against a net long portfolio. So they have a portfolio of, say, they're long a bunch of stocks. they want to hedge against it. So what they do is they go ahead and they'll put a sell position and they'll partially hedge against some of the moves higher, so that you can't always automatically assume that, oh, everyone's trading it, but that's just something to keep in mind on the side. Very heavy range trading when it comes to the DAX and the ASX. Germany 40 and Australia 200 respectively on IG's trading platform. But heavy when it comes to single stock, it's usually heavy to extreme buy, and the focus is primarily on big tech. Institutional interest a little bit higher here than retail, but I'm not going to go through much of that. But just when it comes to Tesla, it's the most popular. Usually, it's consistently the most popular traded single stock at IG, and usually they're net long, but they did manage to time the high around mid last year a little bit better. You can see here that IG client sentiment, majority buy for almost all of it, briefly, when it reached record highs, briefly going to majority sell territory and then back. So that was timed quite nice, but in general, holding majority buys, anticipating further gains. So that's something to note over there. I do want to keep in mind that when it comes to indices, the reason why that a lot of times they'll go ahead and range trade, it's not just because they like to, it's just the fact that indices, the movement that you're going to get day in, day out, 1%, 2%, fine. You get a 3% move. Wow, that's a really big move for an index. Whereas for a single stock, some of these, especially when you got earnings or something major is happening, getting 5, 6, or with earnings 10%, more than 10%, it's not something rare. So you're going to get these big moves on single stock. It's not going to be these controlled moves that you get with indices, because you look at, say, the S&P 500, it's based on 500 companies. So even if you have a handful of companies suffering, say, 6 or 7% drops, it's not going to take the index down by 6 or 7%, because it's got all these other components that either outperforming, finishing higher, or even if they're all in the red. There are these rare sessions where everything's in the red, but not everything's going to be down by a significant amount. And that helps reduce the volatility overall, the percentage moves day in, day out when it comes to key indices. And that just means that when traders are going to approach indices, they're obviously going to consider range trading more. I'm not saying they're not going to try and trade the trend or go with it with a breakout, but they're more mindful that the moves aren't going to be as volatile as the components of that index, or especially if a company isn't even of those components and it's one of those penny stocks that are just going to move significantly. So that's when it comes to that. Let me go ahead and take a look at strategies, and then we're going to go ahead and get into sentiment and trading it. The reason why I want to bring this up is because by default, how is it that traders trade, or how is it that the sentiment traders fade? A lot of times it's about fading a move. What's fading? Say price is rising, it's reaching $1,500. It's selling at or before the level. So at $1,500, they're initiating right there and going against it, anticipating it to go back down. And whether it does go back down, in this example, went significantly higher, about 100 points before coming back down. Regardless of the point, that's essentially how they're approaching it. And the same holds true if they're looking to, if price is dropping, they're buying at or before the level. So in this example, it reaches, and in the second example, you can see that it recovered. This was a sort of range-bound territory, so it recovered, and prices go up. They're sort of shorting at the highs. They're buying at the lows, just fading the moves here and there, trying to trade those ranges. And because we're talking range trading, a lot of times that's a more opportune situation. So you're more likely to see it get stopped out, fade strategies, or at least placing yourself in a position where you're taking on increased risk when you have that increased volatility. In the first case, when you're taking on fading strategies, whereas even though it's useful for range bound or low volatility scenarios, you're going to get more opportunities to trigger. Doesn't mean more opportunities to necessarily make money, but a lot of times you are going to get more opportunities to trigger, regardless of whether or not it results in more money being made, or because at the end of the day, you are taking on more risk because you're initiating those trades a lot more. And I got to add in, just don't get stuck, because at the end of the day, if markets, even if they are on average range bound, if at the end of the day it's going to trend or move to a new zone or jump to a new zone, well, that means that you at the end of the day have to make sure that you have your stop loss in place, because you don't want to get stuck on any move to a new zone. So that's when it comes to fading. What's another way that we can approach the same level? So $1,500 was your key level. What you're doing here is you're selling after the level is breached. You wait for it to come back down first. So on a reversal, back down. So you're still shorting at the same level if it comes back down. In this case, you're avoiding that initial volatile move higher. And you might think to yourself, well, it could come back down and then it could continue to trend higher. Yes, so you could still get stopped out, but you're not basically the pawn going in first. And the same thing when it comes to buying. You wait for the level to get broken there, and then afterwards it recovers and you go ahead and buy. And then in the second example, as prices are sort of edging higher, if it's trending and moving to a new zone, you are not initiating a sell there because it hasn't reversed back down yet. So you're avoiding getting stopped out on that move over there. Again, it doesn't mean you won't get stopped out eventually. If it does come down and then it trends up higher again, you could get stopped out, but at the very least, the initial move, you're avoiding getting a stop out. So you're missing out on more opportunities to trigger compared to say fading. Fading, you're in the market a whole lot more, but you're less prone to being stepped out. So less prone to be getting stopped out, which means less of a. Think of it more like a pawn going forward. The pawn is going to have more opportunities for action. So yeah, you could win big, but it's also more likely to get hit, and that's the reason why a lot of that compared to say, or think of a reversal as using your knight, so to speak. So reversal is great in times of volatility. Market doesn't really know where it's going and prone to reversal. Also helps to avoid any fake moves intended to stop out traders. So what about a third way to approach a level? And because our mindset is always about going against, a lot of times we have a tendency to avoid or not even know this is an option. A breakout strategy, buying a level after it's been breached. So instead of always going opposite or thinking of ways to go opposite, you're going with the move, whether you're going for limited profit taking or a significant amount. I mean, in this case, for example, it offered 100 points, just an example. A lot of times the follow through isn't as great. Breakout strategies can get tested. Look at that in the second example. You went for a sell breakout because it went below a level. Oh, didn't work out. It retraced. Markets moving back towards an average. So in the second example, the first hit making the sell breakout didn't work out. However, in a buy breakout situation, if it does trend higher, that's great. So at the very least, yeah, it's more like you're getting hit, loss, small loss, small loss, big gain, versus when it comes to fading strategies, it's small gain, small gain, small gain, and a potential big loss if you haven't put a stop loss. Great in times of volatility and uncertainty, severely tested in times of consolidation, right? And a lot of times trend traders will really get tested and might even shift their strategies accordingly just because of that. So whether you're using a breakout strategy for limited take profiting or not, you can also use it in conjunction with a reversal. Goes up, you go for limited profit taking. As it's coming back down, you then go ahead and initiate a reversal. It requires the most patience, given markets tend to retrace, but when it moves, when you've moved to a new zone, the payoff can be huge. And now it's time for the main part, final part, and that is about sentiment. Here's the thing: not all sentiment are alike. I know you're thinking, oh, it's majority long, the majority buy. Therefore, if you wanted to go opposite, you go, I'm going to go majority short, or it's majority short, so I'm going to go long. Hold on a second. Before you do that, we need to break it down a little bit. Now, I've attended. This is based on about 10 years of studying sentiment. A lot of times, you want to break it down into these levels where slight sentiment is between 50 to 54%. 55 to 65, 55 to 64, you're in moderate, so moderate buy or moderate sell territory. Heavy is usually 65 to 77, and something when it hits the 78 to 100, you're in extreme buy, or if it's on the other side, extreme sell territory. Where they are is important. Are they in heavy sell? Are they in extreme buy territory? But more crucial is how they got there. Where have a lot of the initiation started? Where exactly is this? Because that will help you understand where is the squeeze occurring. How much more do you think does it have room to run before, say, if it's a short squeeze, before shorts are going to get squeezed and then you have a move back down, which means you only want to go for, say, limited profit taking, so on and so forth. So important to note both where they are, how they got there. And second of all, traders on average, if a trader is going for limited profit taking and taking on big losses, dangerous. Don't recommend it because you're going to take on big losses and it can wipe you out, especially if you go with that all-in mentality. That we covered that with psychology. But on average, if they're right, what that means is it's going to be small win, small win, small win, big loss. Right? So on average, they're right, which means that on average, if you're going to go against the majority, you want to be a little bit careful because you're going to be wrong, big right, potentially, is what I'm trying to say. We are going to break it down by asset class, but or explain it by asset class when it comes to trading it. But that's something to note. You can't just automatically think, oh, well, if they're wrong, if they're going against the trend and the market's going to trend, therefore I'm automatically going to go opposite. Not necessarily. You need to note exactly how exactly you're going against with how much as well. And the thing is that what few trend traders are out there could be forced into range trading if there's significant consolidatory movement prior. This is why I'm saying it's also important to understand how they got there. If you have a lot of consolidation, it forces a lot of them to shift to range trading, or at the very least reduce their take profit because the market's not giving them as much. But when a trend move finally does occur after the fact, sort of, you have a calm and then the calm before the storm. Once the storm does hit, it's very easy to cause sentiment to shift and to approach heavy and the extremes, which is, of course, opposite. The trend is your friend if people are moving that direction. And this is the reason why I was one of the reasons why I'm pointing out as to why is it that we need to understand how psychology is, because then you're going to understand quickly how it'll approach the extremes, which can then trigger a trade depending on what kind of signal you're looking for. And markets, of course, going back and forth gets traders into this mentality of thinking about where to go opposite instead of viewing certain moves as sort of masking where it could go next. So in terms of trading sentiment, you've got two methods. In terms of you want to set up your methodology, you're either going for or you're going against. I say initially choose a methodology for or against, because even if you figure out some key stuff, key trading ideas, whether you're going for, and key items that you could do when against, a lot of times if you don't organize yourself, you're going to end up being a bit of a mess because, oh, they're for, am I against? No, I'm both. Well, that's what I'm saying. Initially, figure out, go for example, figure out some certain strategies of what you want to do for, or where it might work in your favor if you're going with the majority, and then when you're going with the minority, if you're going against the majority, and then maybe you can afterwards, once you've gotten a clear idea of your methodology, then afterwards maybe you can consider taking a mix. But initially, I would suggest choose a methodology and plot your strategy accordingly. Don't try to time both sides. Now, if you're going against, if sentiment, let's say, is majority sell Euro USD and heavy at that, so you want to not just a slight, but ideally moderate, close to heavy, where you think one more push, say, in a bull trend would take into heavy territory, and it's heavy to the extreme at that running opposite a bull trend, you're looking for buy opportunities because you're going against, they're going against the trend, right? They're getting squeezed. So you're thinking to yourself, okay, I want to go against, so I want to go ahead and look for a buy opportunity to go. And whether it's for limited profit taking or because you anticipate further follow through, depends on where they are on the sentiment and how much further it can go to the extremes, right? Because it differs from product to product. That's why I kind of mentioned the products before in terms of asset by asset class. Now, those that want to go in favor, so let's say sentiment is in heavy to extreme sell Euro USD running against a bull trend in price. You're looking for sell opportunities that would go past the average take if they're getting out early. Remember I showed you guys Euro USD earlier about how prices were coming back down and you saw shorts get out and longs initiate. Now, because they're emotionally stuck to the position and they're just looking to get out and avoid a loss, that means if it's coming back down, you could think to yourself, okay, that means maybe I want to go ahead and ride it for more in terms of pullback. And that's especially true when they've been holding losses for a long time, as they're no longer objective. They're just looking to break even. So remember the human nature of not taking on losses, but driven to close out early. Now, once you pick a side, you're looking for opportunities. Don't be afraid to combine it with technical indicators. You can't look and think, oh, I'm just going to look based on sentiment alone. Don't be afraid to combine it with technical indicators, momentum, trending signals, and average movement. So as examples, you've got average directional movement index. This is under DMI, or directional movement index on IG's trading platform. If you click on that, you'll see the ADX reading, usually 20 to 25 and above is considered trending. But a lot of times it takes a while for it to start trending. So sometimes if it's very, very low and it's reached a point where usually that's where a trend is about to start, you want to note that and keep that in mind when you're combining it with sentiment. And average true range on a daily time frame to know what the average gains that could be expected when a move occurs against the majority or in favor of them beyond what they would normally take. So if the ATR tells you on average you're getting 80 points in, say, Euro USD, they're looking for a take from where they got stuck 20 or 30, but the move offers, there's more room for movement. What that means is that it can then afterwards go, say, 80 points or 70 points in favor. So ATR, average true range on the daily time frame to know what the average gains that could be expected when the move occurs against the majority or in favor of them beyond what they would normally take. So if Euro USD, usually, for example, it's you're looking at for example, if on average it's 80 pips, but they're moving 20 or 30 pips, for example, to get out from where they're stuck, then you know that there's a lot more on average. There's a lot more follow through, and then you can use that within a day. I mean, if you're looking to do follow through day, for interday for multiple sessions, that's different. But if we're talking within a single day, then that would help give you an idea in terms of whether or not you could go for more if you're going in favor of the majority, for example. Strategic consideration, fading is the most common. We mentioned that fading is the most common ones, especially when they're range trading in, and it causes sentiment shifts much more quickly. So breakouts when you're going opposite, and more so in a short squeeze situation, even if the squeeze isn't sustainable in the long term. So it could be a short term for limited breakout opportunities, and reversals when you're going in favor after retail traders have been tested repeatedly. So you're doing a reversal there, and then when momentum picks up and it starts to move in their favor, you could actually consider averaging in that direction in favor, not averaging in opposite when you're in loss, but averaging in favor, a sort of snowball effect, like snowball going down a mountain and picking up and getting larger and larger. Now, timing these is going to be very, very difficult because it's so difficult to get a trend move, right? Especially after the fact. When you have all that range trading, it's going to test all of that trend traders and you finally get that move. But this is why if you're going from a reversal at the top, then this is going to give you a chance to sort of go in with a snowball effect and not lose as much or not risk as much if it starts to go in favor. And some final notes here is that normally the advice is you don't want to trade you don't want to trade more than one or two markets maximum. I'm not talking in terms of sentiment. I just mean avoid sentiment. Usually you want to get to know one or two products very, very well. The problem is, though, is that if you're saying, well, in order for a signal to trigger, I need sentiment to be at, say, 65% sell or buy, or so on and so forth. Well, the problem is then what happens is that people have a tendency to select by default based on products where the sentiment is at the extremes. Well, this is why we went through asset classes, because if you see that normally, say in silver or platinum, they're already at the extremes, it's very, very difficult to base, you have to base trading accordingly. You can't say, well, I'm waiting for it to go to extreme sell or under extreme buy territory and say, Euro USD, this is what I do. You can't take that and copy paste it into an asset class where traders are normally heavy to extreme buy by default over long periods of time. The sentiment changes are going to need to be much smaller in order you to trigger a signal. For example, if trading based on, for example, change in sentiment and not just based on where they are. Size management, I mean, just because you're going against the majority, you're thinking, oh, well, they're going to be wrong. You can't go in with an all-in mentality and say, I'm going to load in and go in with everything. No, absolutely not. And from a risk-reward standpoint, when we talked about psychology, about how much you risk and how much you take profit, IG's trading platform, thankfully, already it's available on the platform where you can see, when you put your take profit and your stop loss, you can see the risk reward. So when it comes to size management, when it comes to risk management, you want to obviously note those. This video is not about size or risk management. That's why I didn't go into them in detail, but you obviously need to note those. It's not about going all in for or against. And finally, you want to avoid, when it comes to serious fundamental events, say U.S. non-farm payrolls for USD, FOMC, the U.S. Federal Reserve's monetary policy, for the U.S. dollar, for trading something against the U.S. dollar or the U.S. dollar index, you want to avoid using both sentiment technicals because they're not going to be as reliable. Now, what I mean by that is that you're going to get moves that could easily break levels. You're going to get moves that could easily go in favor of traders if the fundamentals support it. So if traders are majority buy gold and the Fed is reducing rates, gold prices are going to go up. Usually, I mean, that's usually what we see as a reaction if it's a shock move, especially. And I'm not talking about something that's already been priced in and then it's after the fact. But if it's a shock move, gold prices are going to shoot up higher, right? But follow through sometimes against the majority might be larger than when it's in favor. I did a study about this in terms with Euro USD, for example, and it's just that it's not, the fundamentals would match, and it would go, if traders were right, then it would go in favor of those traders. But a lot of times, if you had heavy to extreme bias, if it's going in favor of that heavy to extreme sell, it might be more limiting. Whereas when it's going against, you would see a significant and potentially more volatile move. And with that, I want to thank you guys so much for watching. I do hope you enjoyed this video, and all the best.